Okay, guys. Yeah. So welcome to tonight's lesson. So we're just going to continue based on where we left off. When on Monday, when the load shedding happened here in Cape Town, I'll just quickly recap based on what is actually happening over here, and then we will continue. Okay. So make sure you have that member question open, and I will continue with you. So remember, we're covering the member question and we're doing part A. Part A said, dear student, please calculate the weighted average cost of capital. When a question asks you to calculate the weighted average cost of capital, the first thing you want to get down is the formula. Okay, you can see whether your solutions have the formula or not. There's not always a mark for the formula, but it just helps you to cement your mind. Okay, so you write down the formula. So this is the formula for WACC. Now it may look daunting, it may look very confusing, but remember, to determine WACC, we need three things. We need the sources of finance, we need the market rate or the cost of finance, and then we need the weighting. Now, if you have a look at this formula, you can see this refers to equity. That is one of the types of sources of finance. And then this over here refers to debt. So remember, your source of finance or your long-term source of finance, which is your capital structure, is made up of all equity and long-term interest-bearing debt. So the one side of the formula, one part of the formula refers to equity, and the other part of the formula refers to um, long-term interest-bearing debt. So that gives us our sources of finance, the first thing. The second thing, we want the cost of finance or the market rate, whichever one you want to call it. So here, cost of equity is your cost of finance relating to equity. Then we have KD, which is cost of debt, which relates to the cost of finance relating to debt. As you can see, by cost of debt, there is 1 minus T, whereas by cost of equity, there's no such thing as 1 minus T. The reason for that is the cost relating to equity is dividends paid. The cost relating to debt is interest paid. Now, in many countries, the tax authorities provides a tax deduction for interest paid, but does not provide a tax deduction for dividends paid. And that is why you will have that is why the cost of finance for debt is after tax, whereas the cost of finance for equity, there's no tax deduction. The third thing we want is the weighting. Now remember, the weighting is generally calculated using market values. Now the weighting is this over here. This is your weighting. Value of equity as a percentage of total capital structure. So value of equity plus value of debt, that refers to your capital structure. That refers to your long-term sources of finance. Now, by saying value of equity divided by total long-term finance, you are saying what percentage, what weighting of long-term finance is funded through equity. Similarly, over here, value of equity divided by value of debt is the same thing as this over here, which is your total source of finance, which is your total long-term source of finance, which is your capital structure. So by saying value of debt divided by total long-term source of finance, you are saying what percentage, what weighting of total long-term source of finance of your capital structure is funded through debt. So remember the three things we want: source of finance, cost of finance or market rate, and then your weighting. In most cases, the way we're going to get our weighting is by determining market values. Now, we just read part of the scenario. So we just read part of the scenario. Part of the scenario that we read was the background to the company, and then capital funding, which was what now? Which was point 20, point 21, and point 22. Under point 20, point 21, and point 22, we saw there was capital funding, and the capital funding was made up of three sources of finance. ordinary share capital, bank overdraft, and debentures. So we identified our sources of finance. Remember, we never read the entire scenario. I just read that part. We may miss some stuff, but just to get the gist of the calculation, we will leave it to this. As we do the full question, I'll then just update you to remind you of certain aspects. Okay. So we identified our sources of finance. So now the next thing you want to do is to actually work out or determine the market rate and determine the weighting by determining the market value. So when they say, so this is your thinking process, dear student, please calculate WACC. The first thing you do, write down the formula. The second thing you do is set up this table. The third thing you do is identify your sources of finance. And then you do the fourth thing, which is to determine the market rate and determine your weighting. The way we determine our weighting is by calculating market values. Okay, so that is the recap. Now, we got as far as ordinary share capital. Ordinary share capital, I think, was under, I can't remember, we'll go back to the scenario just now. So for ordinary share capital, we needed market value to determine the weighting, and we needed the market rate. Before you start calculating anything, you first ask yourself, what was I given? Was I given anything? Was I given the market value? Was I given the cost of equity or the market rate? Cost of finance, cost and market rate, I use it interchangeably, okay? So when I say market rate or I say cost of finance, I'm referring to the same thing. So in the scenario, under ordinary share capital, we were given the market value of ordinary share capital at $450,000, but we were not given a market rate. Now remember, to calculate the market rate under ordinary share capital, we have three options. We have capital asset pricing model, CAPM. We have dividend growth model, and then we have the bond yield plus risk premium. The bond yield plus risk premium, that is one of the most common methods used in the real world, but it's hardly tested in the academic world because it's too easy. Okay, so the bond yield plus risk premium, that is yield to maturity plus risk premium. So why is it easy? Because generally they will give you the risk premium and they'll also give you the yield to maturity. In the real world, it's not as easy because in the real world, they have to select an appropriate yield to maturity and they have to calculate the risk premium. In the academic world, both of these are given. So therefore, it's easy in the academic world. In the real world, not as easy. So the most common methods we will be tested on is the dividend growth model and the CAPM. Don't think you will not be tested on this one. You may, but it's most likely going to be CAPM or dividend growth model. They're not going to tell you which method, or in most cases, they won't tell you which method. You need to determine which method. So how are you going to determine? You have to read the scenario and see what information is given. When you see information about a risk-free rate, when you see information about beta, when you see information about the market rate, then you must know they're leading you towards CAPM. Very, very important. Market rate minus risk-free rate is your risk premium. So you must be very careful to see what they give you. Are they giving you the market rate or are they giving you the risk premium? If they give you the market rate, you must say market rate minus risk-free rate. If they give you the risk premium, they're giving you the full bracket. So just be aware of that. Okay. Then over here under dividend growth, you will, if they give you dividends of the next period, if you are given the current share price, and if you're given growth, then they are leading you to use a dividend growth model. So just be aware of that. Like I said, it's not necessarily going to be given, but it's either going to be given or they're giving you information to calculate any of those variables. Then you must know they are leading you in that direction. Like in this scenario, they gave us government bond. Government bond is your risk-free rate. They gave us a different, they gave us like four government bonds, we needed to determine which one. For the beta, they never gave us the beta of our company. They never gave us the beta of Mambo. They gave us a beta of another company, and we have to use that as a starting point to get to Mambo's beta. And they gave us a risk premium. They gave us the entire bracket. So that meant we had to use the CAPM model to calculate our our cost of finance for ordinary share capital. So that's where we're at. So remember, we said to calculate the cost of finance or to calculate the market rate for ordinary share capital, we're using CAPM. How did we know that? Based on the information given, it led us to use CAPM. CAPM is calculated cost of equity equals the risk-free rate plus beta minus RM, multiplied by RM minus RF. So this was the risk premium. So what did we know? The risk-free rate, we were given, your risk-free rate will be government bonds. But we weren't given one government bond, we were given 4 government bonds. I can't now remember the various ones. Then they never gave us beta for Mambo. They gave us beta of another company, and we have to use that to get to Mambo's beta. And then they never gave us the market rate. They gave us the risk premium. Very important. They gave us this full bracket. So just take note of that. On the government bond, what you should know, WACC refers to the general cost of finance. So WACC refers to the cost of finance for the company as a whole. So the general risks and so forth. Okay, so the general market, the general risk of the company. That's what WACC refers to. So you would usually use, so because of the general cost of finance, you will when they give you government bonds to calculate beta for cost for ordinary share capital, you will use the government bonds that is the longest period of time. So generally 10 or 15 years. That's generally the longest period of time of government bonds. So you'll use the longest period. The longest period given was a 10-year bond, which came to 5%. Okay, so they told you it's 5% for a 10-year bond. So that is the rate you would generally use. However, looking through the solution, I saw they used 8%, which was a 4-year government bond. And they used the 4-year government bond because the project, this particular project that they're calculating WACC for, is a 4-year project. Now, like I said, that is something you need to find out from your lecturers. How do they want you to do it? Because if you must read a textbook, they're going to tell you WACC is the general cost of finance for a business. So if you look at, if you pick up SASL, they'll tell you the general cost of finance is whatever, they will have a WACC rate. Then when they go into a certain project that is, so let's say the general WACC is 15%. If they go into a project that have a different risk, then they will adjust the general WACC rate. They will say if the project they're going into is more riskier than the risk of the general company, they'll start off with WACC, which factors the general risk of the company, and they'll say plus or minus they'll add if it's more risk, or they'll subtract if it is less risk. So like I said, without looking at the solution, I'd have used 5%. But because I looked at the solution, I saw they used 8%, and they're using 8% because, and they explained to say that the project is 4 years. But like I'm telling you, when you calculate WACC, you're not working out WACC for a specific project. You're working out WACC for the general company. So as a result, you should be using the 5% because equity is forever and ever. So the closest bond that is, so the bond that is closest to forever and ever is the longest period bond, which in this case is 10 years. So just be aware of that. So you need to find it from your lecturers. Must you always use relative to the project, or is it only specifically in this case, or what? Okay, so find out and then let me know. So that's why we're using 8%. Okay, so that's why we're using 8%. We have the risk-free rate, we have the risk premium of 7%, but we don't have beta. So this is where we are. We start off, if we were given the beta, we simply plug it in. Okay, but we weren't given beta of Mambo. We were given beta of a comparable company. Can't remember the name. So the comparable company's beta was 1.4. Now, to move from the comparable company to the beta of Mambo, you must adjust for differences between the comparable company and Mambo. So if I go to the scenario, so we go to the scenario, you should see the scenario on my screen. So if I go to the scenario over here, so if I go to the scenario over here, they're telling you the beta of FSUN Ltd, an entity listed on the Zimbabwe Stock Exchange, is 1.4. FSUN now, they're telling, so that is the comparable company. You know you can't use 1.4 because it's not Mambo. So what you do, you start off with this 1.4 and you adjust for differences between Mambo and FSUN. Because remember, FSUN's 1.4 is based on what their company is all about. So ours can't exactly be 1.4 because we are not the same as FSUN. So they say FSUN owns 3 motels and 6 hotels. We know we're only going into hotel or motels now. So we're only going to have 1 motel. So as you can see, the first thing we said was Mambo is not listed. So by being not listed, it is higher risk relative to a listed company. Why? A listed company stock is on the JSE, on a stock exchange. So whatever the Zimbabwe Stock Exchange. So by being on a stock exchange, it is easier to buy and sell the shares relative to a private company where the shares are not trading on a stock exchange. Okay, so that is why a non-listed company is more riskier than a listed company for that aspect that you can't easily trade. Then we brought in this. Member only have 1 motel. They don't even have 1 motel. They're only considering getting 1 motel. Where FSUN has 3 motels and 6 hotels. So for this reason, what you call will be a higher risk company. Then they say the management of FSUN comprised of well-experienced and qualified individuals. They have been able to grow the entity to the listed entity that it is today. So probably better. So what you can say. So another difference is better experienced management. Okay, better experienced management compared to Mambo. So why? Remember, these companies, FSUN has been in years doing hotel and so forth. Where Mambo is only going now into hotel and motels. So they must learn how the industry operates. Okay, so therefore they will also be higher risk. Then they say FSUN is part of a well-coordinated hospitality network that does part of the international advertising and referring international clients. Okay, so there you can say FSUN has a better network. So once again, FSUN better network compared to Mambo. So therefore, FSUN is better than Mambo. So therefore, Mambo is higher risk compared to FSUN. And then they say, FSUN's hotel faces a high staff turnover than the industry average. So therefore, FSUN higher staff turnover compared to member. So remember, a high staff turnover means people leave quite often. That is not a great thing. Having a staff leave often is not a great thing. So therefore, for Mambo is lower risk relative to FSUN. Okay, so here you can see now we have factored in all the differences. We have factored in all the differences. A higher risk means a higher beta. A lower risk means a lower beta. Okay? The higher the beta, the more riskier your company or the more volatile your company. So the higher the beta, the more volatile your company. The more volatile, supposedly, the more riskier. So this is not a 100% correct thinking, but just to give you an idea, the higher, the more volatile, the more riskier, therefore the higher beta. Okay, so high level, the more volatile, the more riskier, the the higher the beta. Okay, so therefore, because it's higher risky, it's higher risk, you want a higher beta. So this is basically going to be a plus. That's going to be a plus, a plus, a plus, a plus, and a minus, and a minus. Okay, so basically that is what you just do. You don't also put a number to it. Then you can make up a final number. So now you're going to say adjusted beta for Mambo. Now you can make up a number. You decide. All you can see, there's more positives, less negatives. So you expect this number to be higher than 1.4. Okay, so let's go with 1.6. So I'm using 1.6. They have used 1.6. It could have been 1.7. You decide. You won't get it wrong. But just keep it between 3 and 5. Okay, if you're making it higher than this number, like 2, 3, keep it around there. If you make it lower, 2, 3 lower. Okay, so we made it 2 higher. Okay, so just keep that in mind. What I'm telling you over here, you make up a number. Okay, so don't worry about getting the exact number. All you can see, because you have more risk, you want to have a higher beta. If you had lower risk, you'd have a lower beta. How much higher? How much lower? You decide. Keep it about 2 to 3. Okay, so we chose 2. The reason why I chose 2 because their final answer was 1.6. But you can see how come theirs is higher because it's more risk relative to the comparable company. So now I simply just say equal that. Okay, so when they see 1.6, they want to see we have got 1.6. They will go to working 2. They will see my thinking and they were like, okay, cool, they understand. So now we can plug this into the formula. So remember the formula says cost of equity equals the risk-free rate plus beta multiplied by the risk premium. Remember the formula says RM minus RF, but we were given RM minus RF, so we just say multiplied by that. So therefore, the cost of equity is 19.2%. So if I go and I go plug it in, my market rate is 19.2%. I'm not making it after tax. The reason why I'm not making it after tax, because this is equity. Equity has no tax deduction. So the before tax rate is equal to the after tax rate because there's no tax implications. Now, just in case they want to see we have got that answer, I'm telling them if it is wrong, then go look at working 1. Okay. Even if it's not wrong, we still want to go look at your workings. So just make sure you reference. Now we go to bank overdraft. So for bank overdraft, they said Mambo has an overdraft facility of $15,760 with Capital Bank. The overdraft is considered to be a long-term source of capital by the entity. Remember, Typically, overdraft forms part of short-term financing, or overdraft forms part of operations or working capital. Anything that is short-term, part of operations or working capital, is not part of your capital structure because it's not part of your long-term sources of finance. So therefore, you not generally include bank overdraft. But here they're telling you that the bank overdraft is long-term, so therefore we include it. They say the average overdraft balance averages $14,000. Okay, so all we go do is that is the market value, $14,000. And they're telling you that the member pays an interest rate of 12% on the overdraft. Okay, so it's 12% on the overdraft. I like the cost of a bank overdraft is interest. Interest is have a tax deduction, so therefore we say 12% multiplied by the tax. Let me just see what the tax rate is. Let me just go see what is the tax rate. Sorry, obviously I don't know the tax rate of Zimbabwe. So working three, we will just say before tax rate. It was given to us at 12%. Given okay. Tax rate. So therefore, after tax rate, I'm just going a bit longer. You don't have to still do this long calculation. You can just show it quickly, but I'm just showing you how I get it after tax rate. I was going to see the tax rate quickly. I'm assuming we have additional information. We would have found tax.
I think it's on page 3.
Oh yeah, tax is
Or page 4.
25.75%. 25.75%. So 25.75%. Okay. Okay, so therefore the after tax rate is going to be the before tax rate multiplied by 1 minus the tax rate. Okay, so the after tax rate is that. So I'll go over here. It is equal to C35, and I'll tell them they can go check working 3. Now finally, we'll do the last one. Where was the last one now? Here we go. We did 20, we did 21. Now we're going to do this. Member was permitted to issue debentures which were fully subscribed by a private company. By a private company assisting indigenous Zimbabwe companies. The coupon rate for the debentures is 8.5%. The bonds will be redeemed in 5 years' time at a premium of 5%. 300,000 was raised from the issue. Agent fees of 1% of the debentures were paid by member to facilitate the company, to the facilitating company. Okay, so now let's work it out. Okay, so let's just quickly work it out. So now we know, remember we need two things. We need the market value and we need the market rate. So let's see what we can work out first. So what you guys usually do is the following. Your market value equals value multiplied by 1 minus what you guys call, what was it called now? 1 minus fees, or let's call it transaction fee. Okay, so 1 minus transaction fee. So in this case, we're going to have market value. We're going to have transaction fee. Transaction fee. So let's just say value, as I put in brackets, before transaction fee. So we are trying to get this amount over here. I like to highlight in green so I know what I'm calculating. My market value was given to me as 300,000. 300,000 was raised from the issue. So if I go $300,000, my transaction fee was given to me as 1%. Was it 1%? Yes. So now I can say my market value is my value before the transaction fee multiplied by 1 minus the transaction fee. So therefore, my value is 297. So that's my answer, C39. So if I go over here, debentures is equal to C39. The market value is after the transaction fee. Where did I get that? Working for. Now I can work out the cost of debenture. So remember, I want cost of debenture, so working 5. So how am I going to get the cost of debenture? We can use the because there's a time period. It is a redeemable debt instrument. What makes it a redeemable debt instrument? There's a specified date of repayment. What is the specified date of repayment? It is 5 years time. So we know in 5 years time we're going to have to make a payment. We're going to have to settle the debt. So therefore, it is a redeemable debt instrument. So how we can calculate the cost is by using your financial calculator. So cost on the financial calculator is I. Okay. You guys have a financial calculator like HP or Sharp or something? So you will see that the top row will have these 5 buttons: I, present value, future value, PMT, and then N. So to just give you some background, I is the market rate. Okay, so you know what is what. I is the market rate. Present value is basically market value today, or the current market value. Okay, FV is lump sum. FV, your future value, is your lump sum payment at the end of the period, plus a premium, or minus a discount, or minus a discount. Okay, I'll show you now. This question have it. PMT is your fixed regular payment. Okay, so PMT is your fixed regular payment, and N is the remaining number of payments or compounding periods. compounding periods. Okay, so let's just quickly take this out. So I refers to your market rate. PV is your current market value, your market value today. FV is your lump sum payment at the end of the period. It's your future value, which is your lump sum payment at the end of the period, plus or minus, plus a premium or minus a discount. PMT is your fixed regular payment, and N is the remaining number of payments or the remaining number of compounding periods. So the way you get N is equal to number of remaining years multiplied by number of payment periods per year, or the number of compounding periods per year. PMT is equal to face value multiplied by your coupon rate. So I'll show you what your face value. Your coupon rate is basically the rate that is agreed upon between you and the lender. Okay, so whatever you agreed upon. So for example, if you take out a loan by the bank, in your contract with the loan, in your loan contract with the bank, there will be an interest rate. That is the coupon rate. That is the agreed upon rate. That is the rate that the bank is going to use to calculate how much interest you need to pay them every year, every month, or so forth. Okay. Future value is your lump sum payment at the end of your period. Your lump sum payment at the end of your period is your face value. It is your face value plus premium, if there is a premium, or minus discount if there is a discount. There won't always be a premium. There won't always be a discount. Okay, your present value is your current market value. Okay, so using that information, let's complete. We want I. That is what we want. So now let's complete this using the question. They say member, so point 22, member was permitted to issue debentures which were fully subscribed by a private company that assists indigenous Zimbabwean companies. The coupon rate for the debentures was 8.5%. The coupon rate, that is not your market rate. Very important. You must distinguish between the coupon rate and the market rate. The coupon rate is the rate that is agreed upon between you and the lender, whatever is in a loan contract, or in this case, the debenture contract. The market rate is the rate that you can get today if you must go take out the same loan today. So if you must go take out the same debt instrument today, what is the rate that you will get? That is your market rate, which is not the same as your coupon rate. You must know, you have to distinguish, because you use the market rate to discount future cash flows, but the coupon rate, that is used to calculate your payment, the fixed regular payment. They're saying that 100, the 100, what is this now? The $100 bonds will be redeemed in 5 years' time at a premium of 5%. Okay, so we know it's $100 bonds, but we need to know how many bonds. Okay, and we're going to redeem this in 5 years' time. So N is 5. That is the remaining number of years, which is 5. Okay, you raise 300,000. So now you can work out how many bonds you actually sold, right? So basically your face value is your 300,000 Rand. Agent fees of 1% of the debentures were paid by Mambo to the facilitating company. Okay, so let's go do this. The present value, which is your market value today, we just calculated it. So our present value is the 297. That is the market value today. So we tell them we got this from working for. So even if it is wrong, if you carry this into working 5, you're going to get the mark, because now they're marking your thinking. Okay, so that's very important. Remember, the future value is your face value plus a premium. So it is your future value is your face value plus a premium or your face value minus a discount. They told us it's a 5% premium. So therefore it's face value plus a premium. So the easy way to do it is your face value, which is $300,000. Because it's a premium, you just say multiplied by 1 plus 5%. If it was a discount, you say 1 minus 5%. Okay. The payment is your face value times the coupon rate. So it is face value 300,000, 123 times the coupon rate, which was 8.5%. So that's my payment. And then N is equal to the number of remaining years. Number of remaining years is 5. Number of payments per year is 1. So therefore it is 5. Just one thing to take note. Present value must be in the opposite direction of face future value. So I just keep present value negative. We're only doing this because that's how the calculation works. It doesn't mean the number is negative. You have to, Excel's not going to work, nor is your financial calculator going to work. So remember, for the number to work out, your present value must be in the opposite direction to your future value. So what I just do, I make my present value negative and my future value positive. And take note, your future value and your payment is in the same direction. So because my future value is positive, my present value is negative. Because my future value is positive, payment will be positive because future value and PMT is the same direction. Future value and PV is in the opposite direction. So now I can work it out. So I have all the inputs. So I can say Excel, I'll say rate. To calculate the market rate on Excel, you use a formula called rate. I open up brackets. They want N per year. That is N. They want PMT, that is PMT. Then they want present value, so I'll go to present value first. Then they want future value, so then I select future value. Then you can see there is type. Type means whether the cash flows happen at the beginning of the year or at the end of the year. If they don't specifically tell you that cash flows happen at the beginning of the year, you always assume it happens at the end of the year. So Excel, the way Excel identifies that is the end of the year, you select 0. If it was at the beginning of the year, you select 1. Remember, on your financial calculator, you'll have to change the mode on your financial calculator. The default mode on the calculator is end of period. Okay, so you always leave it in that because most cash flows happen at the end of the period. But when they say cash flows happen at the beginning of the period, you need to change your mode on your financial calculator to represent beginning of the period. It will be clear on your display. You will see on your display of your calculator, you will see that the letters BGN. When you see the letters of BGN, it means the calculator is in the mode where cash flows happen at the beginning of the period. Very important to make sure that it's only at the beginning of the period if the question tells you. Otherwise, leave it in its default mode, which is end of the period. And then, oh, this is only for Excel now. When you work out a rate, when you work out a rate in Excel, no matter which rate you work out, Excel requires you to make a guess. In your financial calculator, you don't do guesses. It's only for Excel. So when you use Excel to calculate the market rate, Excel requires you to make a guess. Just to keep my life simple, so that I don't think, I always just keep my guess to 10%. Okay, so I just always put in 10%. You put in any percentage, you choose. I choose 10% because I just use 10% so that I never think. Okay, so well, it happens to be 10%. So I just want to change this for our purposes. So you don't think it must equals. If I change it, you see it's still 10%. You're just making up a guess.
I first.
Yeah.
Sorry to interrupt there. So on the sharp calculator, if you are changing the mode to beginning of period, you said the letters are
BGN.
BGN.
You'll see it on your display, yeah, but you don't want it there because it's not the beginning of the period. Only if the question says beginning of the period, then you want to change your calculator just for that transaction, and then afterwards you must change it back to normal. Okay.
All right, but is it clearly like that BGN on the sharp calculator?
You need, I don't know how the sharp looks. You send me a picture, and then I'll explain to you in the chat. So just send a picture, and I'll show you. Okay.
All right, thank you.
But now remember, this is I, but that is I before tax. What do we want? We want I after tax. So we will say market rate after tax is going to equal market rate before tax multiplied by 1 minus the tax rate. The tax rate is 25.75%. So that should be my my rate. Okay, let's just see what they're doing. Okay. Okay. Okay, so I think what they want you to do, they want you to work out the after tax year already. So they just work it out after tax over here. So I'm going to just take this out. They want you to have PMT after tax. So we will just work it out over here, multiplied by 1 minus T, 1 minus 25.75%. So we'll have it like that. Okay, so just take note over here. Let's just do that. Multiplied by 1 minus tax.
Faiz,
Yes.
just sorry to interject. If we had gone, if we had done what you had done initially to not to the PMT without tax, would have also now done the 1 minus T on that, I would have gotten it. Confirm.
No, because of compounding, it's going to change the rate. So the safest rate is to make sure you take it in over here. Okay.
Okay.
Okay. So the final answer over here is 7.42, which is C43. So I'm going to go here, C43. I'm going to tell them they can find it in working 5. Working 5. So there we go, working 5, working 4. So they have they can find everything. Now remember, we need 3 things to calculate. To calculate WACC. We need source of finance, we need market rate, and we need weighting. Now remember we said the general way to get weighting is to determine market values. So now we have determined market value. So now I can add it up. So this 761, refers to this over here. Your total sources of long-term finance. It is your long-term capital structure. Okay, so at 761 is this VE plus VD. This VE plus VD. Okay, so that's 761. That is your total sources of long-term finance. That is your capital structure. Now we get the weighting. The weighting is going to be value of equity, VE, divided by total sources of finance. Similarly over here, it is going to be value of bank overdraft divided by total sources of finance. Similarly over here, it is debentures, value of debentures, value of debt divided by total sources of finance. All you need to make sure that this adds up to 1. It adds up to 1, so we're happy. So therefore, 59% of your total source of finance is funded through ordinary share capital. 2% is what is this? 2%, is 2%. Yeah, okay. 2% is funded through bank overdraft, and then 39% is funded through debentures. Okay, now we can get our WACC. It is A times B, just multiply this by 100. Okay, so there we go. A market rate times weighting times 100. Same thing, same thing. Okay, so now we can add up. So our WACC is, so that is our weighted average cost of capital, which is 14.41%. So that would be the answer. Just I want to mention something to you specific to this scenario. That there's another item we need to include over here, but I'm not including it now because we need to read the entire scenario. So it's somewhere under somewhere under, if I show you somewhere under the scenario, under the motel, we need to read everything under here to get the other source. It's one more source of finance. But because it's not going to take away from the bigger picture, I'm not going to bother with it. I'll bring it in once we do the capital budgeting question. Because when we do the capital budgeting question, we have to read the entire scenario. So once we read the entire scenario, then I will finish up. I'll bring in the last source of finance. But I don't want to read through a whole scenario just for one source of finance. It's not going to change what we're going to learn. So in general, this is how we're going to do it. Assuming there was only this 3, there isn't that other one sitting under somewhere under the capital budgeting stuff. This is how you would do it. Okay. So this is the standard way. In the real world, same thing. This is a standard way you're going to do it. Obviously, in the real world, it'll be a little bit more complex in the sense that some stuff is given to us. They gave us a comparable beta. In the real world, you probably have to find a comparable beta. In this year, they gave us the risk premium. In the real world, you have to go find, you have to calculate or determine the risk premium. They gave us the various government bonds. You would have to go find the government bonds, but that's generally quick to find. So you understand in the real world, same thinking process, just a little bit more complex because the information provided, you would have to source yourself in the real world. Okay, so that's all I wanted to cover. So you can see the WACC. As we go through more questions, we will do some more WACC questions and so forth. What you can do is that on my YouTube channel, on Edion's YouTube channel, there is, I think, either 2 or 3 WACC questions that you can watch. And then there's also 2 or 3 capital budgeting questions. But don't watch capital budgeting yet. Watch capital budgeting after we cover capital budgeting. Why I'm saying that? Because although WACC is the same, I can see there's some slight differences in the way your question is provided relative to how we provide it here in South Africa. But the principles, the thinking process, and the concepts will still be the same. So I see for you year over year, a lot of the market values are given, and it's not even clear that is the market value. So like, for example, that 450, I didn't really know that was the market value. The way it's worded doesn't indicate to me that it's the market value. That's the only number given, so I can only assume it's the market value. Same thing over here, the bank overdraft was okay, it was fairly straightforward for that one. And then this over here, it wasn't really clear whether the 300,000 was the market value, although they correctly took out the transaction cost, but it wasn't clear whether the $300,000 was the market value before transaction costs. but because like I guess from experience I could pick it up. Okay, that is the only number given. That's the only number I can use. So there are like small differences, but to a large extent, if you watch, there's about two or three. I can't remember how many, but I think there's about at least two whack questions that you can watch on the website. Just some of there's quite a few videos. So, but the whack is clearly marked. Okay, so if you want to watch, you can see, and we go into a little bit more detail with some more of the stuff. So maybe you can watch that. Then you will also learn some more. You will see again, I'm using the same thinking, the same concepts, the same principle to answer a whack question. Then once we do capital budgeting, you can do the same thing for capital budgeting. Okay. Um,
I first,
that's all I wanted to cover over here now. But before we end the session, is there any questions? So I'm asking, you can ask me any questions. Okay, so see Justin, you there? Do you want to ask any question?
oh, okay. I think, yeah, on the work, there could be about two videos, so that I'm just making a follow-up on the YouTube videos that you have indicated. But on capital budgeting, I only saw one video posted sometime in February this year. I don't know how I'm also missing the other two, or any other one.
It'll probably be released by tomorrow. Okay.
Oh, okay, okay.
Okay.
Thank you. I think
Okay.
that would be even
Okay.
more beneficial as well. Thank you.
Pleasure. Any more? Any questions from your side? Just see some, there's a question in the chat.
All right, probably one last maybe question.
Yeah.
So on the payments, we calculate the payment net of tax, right, after tax. So I'm trying to get the principle there. Is it always the case that the payment has to be after tax? Because I'd also gotten used to the then I actually, the answer there, I will actually,
So like I generally don't use it after tax, but it's more correct after tax. So what you want to try to do, what we're trying to get, we're trying to get okay? We're trying to get a market rate. That market rate is going to be plugged in your WACC calculation. The WACC calculation is a market rate after tax, okay? Now, your market rate, I, N, and PMT generally talks to each other. So I, N, and PMT talks to each other. Because your market rate is after tax, PMT must be after tax. If your market rate is before tax, PMT must be before tax. But so let's just quickly do this. Let's just quickly do this. If I just take this away, if I just quickly take that away, so you see it's 9.59. If I make an after tax and if I say that multiplied by an after tax rate, 1 minus 25.75%, you can see I'm not getting the same answer. When I had it after tax by having PMT after tax over here, I had 7.42. Here I'm having 7.12. And the reason for that is, it is because this one is not taking compounding into account, where this calculation is taking compounding into account. So therefore, the more correct approach is to take after tax over here and not to have this before tax. Okay, so that's important to take note. I'll mention the relationship between PMT and N in another example, but why it's better to take the tax over here is because of the compounding effect. You're going to get the more accurate you're going to get the more accurate cost of debt rate, or you're going to get the more accurate I. So that is why you want to have it over here as 1 minus your tax rate. So I think I usually don't have it in over here, but as I was working through examples, I realized it is actually incorrect. So this approach is the more correct, where your PMT is after tax. So rather just follow that rule. PMT after tax, so that you factor in the compounding effects. I hope that answers your question, Justin.
Yes, thank you very much.
Edmore, anything?
I've got no question, Faiz. Thank you.
Okay, all good. Evan Kalista, I'll pronounce your name. How do you pronounce your name? I can't hear you.
I don't have any questions, sir.
Nothing. Okay. Walter, you can go.
Hi, Faiz.
Yeah.
I was looking at, can you kindly go to the table where we are calculating WAG?
We go with,
I was facing the,
yeah.
So I was facing challenges in the, so for example, when I was calculating the bank overdraft, I was saying 8.91 multiplied by 0.02. I was failing to get the 0.016. Can you kindly give me guidance?
0.016.
Am I supposed, is this one the first one?
I mean 0.016.
Is
Wait, 0.016? Oh,
yes.
this year.
Oh,
Oh,
it's
this
zero.
year. Oh, this year. Okay, I understand. So it should be 8.91%. Okay, multiplied by 0.02. So you need to have that in the percent. You can't say 8.91. You must say 8.91% times 0.02.
Okay.
You should get the answer.
Okay, it's okay. Thanks.
Okay, cool. Any other questions from Walter? Nothing. Okay. Kudzai. Just if I pronounce your name incorrectly, please just rectify me, because we have a few lessons. I would like to pronounce your names correctly.
No questions, thanks.
Okay. Taurai.
Yes, for me, and is it under debentures
Yes.
where we had 1% transaction cost?
Yes.
If we didn't have any transaction cost, was the present value 300? Was it going to be 300?
Correct.
Okay.
Tinashe.
No questions from me.
Okay. We had Walter. Okay, so everybody. Okay, so we'll stop it over here. Do you want to do your fact tomorrow?
I think so. Do we have a lecture tomorrow, Tim? I think we can have it.
Okay, can you just tell me in the group?
Yes, I think
Okay.
we can.
Okay, so I have fact
We
tomorrow.
can.
I'll tell you tomorrow during the day which question we'll cover. I already have the question I selected. I just can't remember the name. Okay, so I will when I open up and I'll see it and I'll know which one it is. I'll tell you which one it is. Okay.
Is 6 o'clock okay, Faz?
Do you prefer 6
Just
o'clock?
to before 6.
Do you prefer 6 o'clock?
No, we can't before 6.
No, so
6:30
6:30
is fine.
Okay.
Because we'll be
6:30 is
coming
fine.
from work. Yes.
Okay, that's fine.
Oh, I was trying to see if we'll be able to cover before the 8 o'clock load shedding.
Oh, no, load shedding is sorted here now, so it's fine.
Okay.
Yeah.
Oh, that's
Yeah.
fine. That's
Okay.
fine.
It was only up until Tuesday. Only up until yesterday.
Okay.
Assuming they don't change it tomorrow, okay? But so far, only up until yesterday. Okay.
Great,
Cool.
great.
Yeah.
Then
I will send the recording probably by tomorrow, Friday. Okay.
Okay.
Oh, all
So we'll be having our lectures during the week. We no longer have on weekends.
Now we're
Confirm.
gonna have it on a weekend. I just the past weekend I couldn't. So
Okay.
because this week my CTA guys are not having class. They resume next week. So from this weekend, Saturday and Sunday, we will have our sessions. Okay.
Okay. All right. Thanks.
thank you.
Perfect. Okay. Bye-bye.
All right, bye.
Thank you so much. Bye.
Pleasure. Bye-bye.
Thank you, sir.
Bye, guys.
Bye.